Hi, I'm Ed Slott. I'm a CPA and have been in practice for over 25 years doing estate planning, income tax planning with people just like you, helping them to protect their money from taxation. And I've seen some horrible things, and I want to share some of those with you so this doesn't happen to you and your family. I call this program 10 Financial Disasters You Can Avoid. Number one, we're talking about your retirement account. This may be your largest single asset. For a lot of people, it is. It may be all the money you worked for your entire working life. But many people think they have a plan, but they don't. Most people don't have a plan. You know why? The big mistake is they think it's covered in their will. I get this all the time. When people come into our office, they say, well, I think this was taken care of. Luckily, they come in. How many people don't come in, maybe like you listening to this program and saying, you know, I thought I took care of that. I went to the attorney. I got myself a will. I got a trust. I did all kinds of things. But I'm telling you, when it comes to your retirement account, it's very likely nobody took care of this. Why? Because retirement accounts generally don't pass through these documents. They pass through IRA beneficiary forms, company plan beneficiary forms. And then, I know many people deal with financial advisors, but most financial advisors don't take care of this either. Financial advisors generally might be good helping you make money, accumulate money, but they don't do the second half of the game. They don't help you keep it away from the government, create a plan. Remember, if you don't create your own plan, you're going to get the government plan. So what I'm telling you, this is not covered in your will. That's mistake number one. Too many people think this is covered by some document, some fancy, sophisticated estate planning. No, it's the IRA beneficiary form, and unfortunately, almost nobody can find these forms. Mistake number two is, even if you do have the form, not naming a beneficiary or not being able to find it. You know, I find so many times children of clients will come in and say, you know, mom or dad has passed away, and they say, you know, we want to find the beneficiary form. Now, that's too late. They're already dead. The idea is to do this ahead of time. Locate the beneficiary form. Talk to your advisor. Work out a plan. Name beneficiaries on the IRA beneficiary form. Here's what I mean. You have primary beneficiaries. Those would be the first people to get it. Contingent beneficiaries. Both have to be named. Remember, an IRA is different than all other assets. It's unbelievable, but the naming of the beneficiary, the person you choose as your beneficiary, determines the ultimate value of this account. Unlike any other asset. You know, you take a house. If you leave your house to your son as opposed to your daughter, it's not going to be worth more because you left it to one as opposed to the other. But with IRAs, they do work like that. For example, if you leave it to your mother, it's not going to be worth as much as leaving it to your child. Why? Your child has a longer life expectancy. They can extend distributions, keep the tax deferral going over their entire lifetime, which is a lot longer, according to actuarial tables, than the lifetime of your mother or your brother. So it is the beneficiary that will determine the ultimate value of this account. And the other thing to keep track of, or to keep in mind, is that the IRA beneficiary form trumps all other legal documents in most states. That means even if you think that this was covered somewhere else, if you don't have a beneficiary form, you won't get the tax benefits. The beneficiary form trumps all. For example, you have a divorce. People don't change it, and all of a sudden, it goes back to the ex-spouse, and the beneficiary form trumps it. It's the ex-spouse that gets the money. We saw a case with a local police department where we found a lot of the police officers were naming their mother as their IRA beneficiary. And these people were married. They had wives. And nobody thought to change it after they got married from the mother to their spouse. So these are the things you have to keep track of. You want to make sure you have an IRA beneficiary form. Not having a beneficiary might end up having this IRA or retirement account go through your estate. That's a bad choice. That means it will be subject to probate. You know, if just by naming a beneficiary, the IRA is no longer subject to probate because it has a place to go. It's spoken for. So it's very important to make sure you have a beneficiary form just to avoid probate. Not only that, once it goes to your estate, you don't know who gets it. It goes through your will. Somebody can contest the will. Another bad thing that can happen by not having an up-to-date beneficiary form, if the beneficiaries are not individuals, your children, say, or grandchildren, the IRA may not have a designated beneficiary. What does that mean? It means there's no life expectancy, which means the money has to get paid out a lot quicker than if you left it to your son or daughter who could stretch it over their lives and parlay it into a fortune. Also, make sure with the IRA beneficiary form that you know where it is. It's not only filling it out, keeping it current, naming primary contingent, but everybody's got to know where it is, because if they can't find it, your family, after you die, that's it. It'll be treated as if it never existed. Then all these bad things will happen. This great parlay of wealth, the stretch IRA, is guaranteed for everyone under the tax code, but you have to have a named beneficiary, a person with a life expectancy, and it has to be kept up to date for what I call life events, because things do change, things happen. You have a birth, a death, a marriage, a divorce, you had a new grandchild. These things have to be addressed. So when you have one of these events, when you're listening to me now, you should be saying, you know what, we did have one of these events. Maybe we should speak to our advisor or go to the bank, broker, a fund company, wherever you have the IRA money, and make these changes and make sure these changes are recorded. Many times these institutions lose these documents. The beneficiary form is the key to the estate plan for what may be your largest single asset, that retirement account. That's mistake number 2. Mistake number 3 is not being aware of key retirement options. Here's what I mean. You've put in your time, you've worked, and now you're ready to retire. You're ready to take your money out. But what do you do with it? There are a lot of choices there. You could roll it to an IRA. That's usually the best choice, actually. But there are other choices. You could leave it in the plan or move it to a new plan, or even take the money out now and pay tax. Why on earth would anybody want to do that? Some people need the money. I mean, that is an option, but there are huge tax advantages that most people are not aware of. For certain people that qualify, this is something you need to go over with a qualified advisor that understands distribution options. I'm going to mention 2 huge tax benefits that most people don't get to take advantage of because they don't know it and the advisors don't know it. Number 1 is net unrealized appreciation, NUA. It's a big tax benefit if you have company stock. Also, 10-year averaging. Now, for 10-year averaging, you have to be born before 1936. So it may not be available to all of you, but it is there. Those are lump sum distribution options. If those apply to you, and again, work with an advisor to see if this is for you. If those apply to you, it may pay to take the money out and pay the tax, because you may end up paying much less tax than if you rolled it to an IRA. But generally, other than those options, the best option is to roll it to an IRA where you can take control of your money. But you have to be aware of all the options. Again, the options are: roll it to an IRA, which I think generally is the best option. Leave it in the company plan or roll it to a new company's plan. Generally, I believe that's the worst option. There are some reasons to do that, and that's something you should go over with your advisor. There are some reasons, but generally they're all bad, and you never want to leave it with your ex-company or even your new company. If you have a chance to take it out and take control of that money, it's best to do that. So that's what I would do. Roll it over to an IRA, or the other option is to use the lump sum distribution option, pay tax now, but get those tax breaks. That was mistake number 3. Number 4, costly rollover mistakes. This is one that happens to almost everybody. When you move retirement money, you generally get one chance to do it right. That's it. You get one chance. So you have to understand what moving money means. In other words, let's say you have money in a 401k, you worked there many years, maybe you have $500,000 in your 401k, and you want to roll it to an IRA. There's ways of moving the money that are more advantageous tax-wise. For example, you could take the $500,000, take possession, and move it to an IRA. That's called a rollover, what we call a 60-day rollover. But that's a bad option, as opposed to something called a trustee-to-trustee transfer. That's where instead of taking possession, you take the money from the 401k. You don't take the money, actually. The money goes directly from the 401k directly to the IRA without you touching the money in between. You never touch the money. That's the best way to move retirement money. Why? Because if you use the 60-day rollover where you take possession, 3 bad things can happen. Number 1, you have to get this done in 60 days. Now, you might be saying, oh, that's a lot of time, so it's 2 months. I'll take the money out, move it to the IRA. How hard is that? From my experience, I got to tell you, this is one of the biggest mistakes people make. They don't get it done in 60 days. They think they've got it done in 60 days. Here's what happens. They don't do it right. The bank makes a mistake. It ends up in an account that's not an IRA. But you don't know it because nobody went back and checked anything. So when is it found out? Not in 60 days. Months later, when you, next year, go to your tax accountant or you're doing your taxes, and the accountant might say to you, "What'd you do?" And you say, "What do you mean, what did I do? I just took the money, rolled it to an IRA, but it didn't get to an IRA." Well, now you're past the 60 days, and guess what? If you blow this 60-day rule, the money is taxable. Now, there are some ways to fix it, but they're costly. It involves going for a private letter ruling and praying that IRS will bail you out. So that's the first bad thing that can happen. You're subject to the 60-day rule. When you do a trustee-to-trustee transfer, there's no 60-day rule because it happens instantaneously. The second bad thing that happens is if you take possession of the money, there's mandatory 20% tax withholding. This is also a bad thing. Why does the government require tax withholding if you do it this way, where you take the money, as opposed to a direct trustee-to-trustee transfer? Well, it's easy. The government doesn't trust you. If you're going to take possession of the money, they're afraid you'll spend it all and not remember them. So they take 20% out. So let's use our example that I gave you before. You have $500,000 in a 401k. If you do a 60-day rollover where you take possession of the money, guess what? You're not going to get your $500,000. You're only going to get $400,000. They're going to keep 20% for tax withholding. Now, you'll get that back when you file your tax return, but that may be too late. Now you only have $400,000 to roll over in the 60 days. You didn't roll over the whole amount. So unless you have $100,000 sitting around somewhere, you're not going to have enough to complete this rollover. So then what happens? Well, then that $100,000 becomes taxable. But it could get even worse. If you happen to be under 55 years old, which is the age for plans, it's a 10% additional penalty. That's an additional tax on top of the tax. So what a quick way to wipe out your retirement savings. Stay away from the 20% withholding. And the only way to do that is to do a trustee-to-trustee transfer. The other bad thing that happens if you do a 60-day rollover, now this is only in an IRA, is you can only do one per year. And here's where people get themselves in trouble. Here's what happens. You have money in an IRA, and you decide, you know what? I want to move it to a different bank. Well, you have 60 days to do it. And let's say you do that, all well and good, that's fine. But then you decide 3 weeks later, I want to do it again. I want to move to a different bank. This one's giving me a toaster. I don't think they've done that in 20 years, but let's say they do. So then you move the money to this other bank. Well, now you've done 2 rollovers within 12 months. It's all taxable, and this one can't be fixed. You can only move the IRA money once every 12 months. Many people blow this because they do this 60-day rollover. The second transfer within 12 months is taxable. It's the end of your retirement savings. Better option? Do a trustee-to-trustee transfer. It eliminates all 3 problems. No 60-day rollover problem because it passes instantaneously. No 20% withholding. And you can do as many trustee-to-trustee transfers as you want. If you want to change investments every day, do them as trustee-to-trustee transfers. There's no limit. So that's a big mistake people make. I've seen retirement accounts get wiped out by making that mistake alone. Don't let that happen to you or your family. Mistake number 5, not knowing about the stretch IRA option. This is kind of a double mistake because you could make it if you have the IRA, And it's really for your beneficiaries, for your children and grandchildren. Let me just go through again what the Stretch IRA is. It's a process. It's the ability for your beneficiaries, and they have to be human beings. They have to be somebody with a life expectancy. And I'm not joking about that it has to be human beings. I mean human beings, as opposed to a charity, a trust, an estate. Real people with a life expectancy. So let's say we're talking about your children or grandchildren. Children are probably the most common. If you name them as a beneficiary on the IRA beneficiary form, after you die, they automatically, and this is the default in the tax law, get to stretch or extend distributions over their lifetime, keeping the money away from the government for their entire life, just taking minimum distributions. This is why I call this the great parlay of wealth. But some IRA owners don't even know about this. So even if you filled out a beneficiary form correctly, technically your children should get the Stretch IRA. But they may not know about it. That's a big mistake, not knowing about it, because if your children don't know about it, guess what's going to happen? You die, they inherit your money. The first thing they're going to do is reach in and grab it and take it all. They'll get hit with all the tax at once, and that's the opposite of building wealth. The way to build wealth is to keep your money away from the government for as long as possible. By reaching in and taking it right up front, right after death, you're front-loading it. You're giving it all to the government right away. They'll pay huge taxes. The amount they take will be added to their current income, all because they never knew about the Stretch IRA. You've saved and worked hard for this money your whole life. It pays to talk to your family, your beneficiaries, to let them know about the huge tax advantage, this Stretch IRA that you created for them. Many times they don't know and they blow it. And many times somebody tells them after the fact when it's too late. See, once a beneficiary, especially a non-spouse beneficiary, takes the money out, you can't fix it. In case you were thinking, well, when they find out, they can just put it back in. No, they can't. Once it's out, it's out. A non-spouse beneficiary, like your child or grandchild, cannot do a rollover. A spouse can, but not a non-spouse. That means once they take it, it's taxable, and it can't be fixed. And that ties into mistake number 6 in our list, mistakes in setting up inherited IRAs. So not only does your beneficiary have to know about this inherited IRA, getting the Stretch IRA, they have to know how to set it up. And I'll say that rule again. It might sound like tax talk, but a non-spouse cannot do a rollover. What does that mean? If your child or grandchild takes the money out, they can't say, oh, I changed my mind, I want a do-over, I want to put it back in. No, they can't. It's taxable and it's over. So they have to know, and you have to tell them, somebody has to tell them, how to set up a properly titled inherited IRA. Remember, a spouse can do almost anything. If you leave your IRA to your spouse, he or she can roll it over, put it in their own IRA, no problem. A non-spouse, like your child or grandchild, cannot do that. So they have to be very careful. The way an inherited IRA should be titled is a specific way. The titling of the account should include your name, the deceased IRA owner's name in the title. So it should read something like John Smith IRA, deceased, with the date of death, FBO, for the benefit of John Smith Jr., the son in this case. So John Smith IRA, deceased, date of death, for the benefit of John Smith Jr. That's the proper titling of an inherited IRA. This is not a suggestion. This is in the tax code. If it's not titled that way, the IRS could deem it all taxable and the stretch option is lost, and it all gets triggered in one shot. So they have to know first how to set it up and title it correctly. They also have to know that if they ever, and when I say they, your children, if they ever want to move the money, it can only be moved as a trustee to trustee transfer, like we talked about before. They can't do, the only way they can move it, let's say you left it at some XYZ bank, and your children say, I don't want to keep it in that bank. I can do better investments here. So they want to move it to a different place. If they take it out, it's taxable. because a non-spouse cannot do a rollover. So the only thing they can do, if the custodial agreement allows it, and the custodial agreement is kind of the rule book for the inherited IRA, and that's the rule book of the financial institution, the bank, broker, or mutual fund company that's holding the money, they have to allow a trustee-to-trustee transfer for inherited IRAs. Not all of them do. Another big mistake that beneficiaries make, they're not told about these things. So mom dies and the son's the beneficiary. What does he do? He puts it in his own IRA, not a properly titled inherited IRA, all taxable, and it's over. We saw a situation recently where an advisor told me this story. He came across a young woman, 23-year-old woman, already had $500,000 in her IRA. And he said, he had a question. How could you do it at the even $4,000 a year, $5,000 a year contributions, whatever the amount was when she contributed? It's almost impossible. He said, how'd you do it? She said, oh, that's not my money. I inherited that from my dad 2 years ago when he died. It was in her own IRA. It's all taxable. P.S., the end of the story, the IRS hit her for 2 years. Remember, by the time they found out, it was 2 years later. So the whole $500,000 was taxable, plus interest and penalties for the 2 years. But wait, there's more. Plus another $30,000 penalty each year. There's a 6% excise tax for putting too much money in an IRA. 6% of the $500,000, she had to pay $30,000 each of the 2 years, because when she inherited, the most you can put in your own IRA was $4,000, not $500,000. The entire retirement account, the inherited money, was lost. Here's a situation where I talk about first half of the game and second half of the game. It took Dad 50 years to accumulate this money. She lost it in 5 seconds in the second half of the game because she made a critical mistake like this. And we talk about the stretch IRA, the power of that parlay of wealth. Do you know, if she set it up correctly, not in her own IRA, but with a properly titled inherited IRA, she could have stretched or parlayed this wealth. The life expectancy of a 23-year-old was about 60 years. Look at this. She had a lifetime legacy, but it was blown with one mistake like this, a mistake setting up inherited IRAs. Don't let that happen to you and your family, because these mistakes cannot be fixed. Number 7 in our list of the top 10 here, and now you're starting to see these really are financial disasters. These are the kind of things that I worked hard to set up this money, and it gets whooshed away just with one mistake. This is happening all over America, and more people are getting hit with this because more people are inheriting, more people are accumulating retirement money. Number 7 is something I spoke about a little before, but I'll go into more detail now. Missing the NUA tax break. Here's what we're talking about. NUA stands for Net Unrealized Appreciation in Employer Securities. Here's the situation. Most people with money in a 401k probably have most of that 401k money invested in their company's stock. It's very common. If you're retiring and you have a substantial amount of company stock, and I mean stock of the company you're working for, in that account, before you do a rollover, check to see if taking advantage of the NUA tax break is right for you. I'll give you a little example. I'll give you an extreme example to show you about the appreciated stock. There's a huge tax benefit if the stock in your company plan has appreciated. And who gets the big benefit here? It's people that have worked for a company many years. Longevity. The longer you work, chances are the more that stock went up in many companies. So here's what happens. Let's give a little example. Let's say you've accumulated $1 million in your retirement account, your 401k at work. And just to make the example easy, let's say it's all in the company stock. It shouldn't be. That's too much in one investment. Again, I'm not an investment guy. I'm just giving you the tax end of this. But most people will say that's too much of the investment concentrated in the company stock. But just for our example, let's say the entire $1 million is company stock. And the cost, that's what it's worth now when you're ready to retire. And the cost of that stock when you purchased it in the plan was only $100,000 because you purchased it over many years. Well, if you agree to take a lump sum distribution rather than rolling to an IRA, in other words, you agree to take all that stock out as stock, something called in kind. You don't sell it in the plan, or otherwise you blow the tax break. You take it out as stock and you move it, say, to a taxable brokerage account. You only pay tax on the cost. In our example, only on $100,000. The other $900,000 is NUA, net unrealized appreciation in employer securities. It comes out tax-free. If you rolled that to an IRA and pulled it out of the IRA, you'd pay full income tax on that. You don't pay any tax on this $900,000 sitting in the stock in your taxable brokerage account until you sell that stock. And even when you do sell the stock, you get guaranteed long-term capital gain rates, which are much lower than regular income tax rates. So even if you turned it around and sold it right away, and that's another benefit, even if you sell it the next day, you still get long-term capital gain rates. It's a special rule for NUA stock. If you didn't know about this and you moved it, like most people do, right to an IRA because you weren't aware of the NUA tax break, if you pulled out that $1 million from the IRA, you'd pay tax on all of it at ordinary income tax rates, the highest tax rates in the land. This is a way to keep more of your retirement money by taking advantage of the NUA tax break. This is something you should ask an advisor about it, ask about it at your company. And don't be surprised when you ask about it that the company says, "We never heard of this." That's what they're going to say. Most people in most companies haven't heard of it. But I found working with clients that my rule seems to be 5 to 7. What do I mean? I have to make 5 to 7 calls to the company till I get to the one person in the whole company that ever heard of this. But it's in the tax code, and you can take advantage of this. Remember, this is a tax break for those of you that have appreciated stock, company stock of the company you're working for in your 401k, and you agree to take a lump sum distribution. Technically, the definition tax-wise of a lump sum distribution means you take your entire plan balance, and if you have assets other than the company stock, that has to come out too, but that can be rolled over to an IRA. The entire plan balance has to come out in 1 year, in 1 calendar year. The balance in the plan at the end of the year has to be 0. It comes out in 1 calendar year. Then you qualify for a lump sum distribution. But even if you do that, you only qualify if you have what I call a triggering event, a qualifying event. And there are 4 triggering events: reaching age 59 and a half, death, disability, and separation from service, which is the most common one, when you leave the company. So after you have one of those qualifying events, in any year after that, if you're willing to pull everything out in 1 year, you qualify for this NUA tax break. And I think if you have a lot of company stock, and most people with money in 401k plans do, this is something you should look at. What should you do? First, see how much of that plan balance is in company stock, and then see how much appreciation there is. There are some companies where there might not be that much appreciation, might not be worth it. But if you've been on the job quite a bit at a company for 20, 30 years, there could be significant appreciation over all the years. Remember, even when the market goes down, it eventually goes up. Remember, the market goes up and down, but over time it goes up and down, up. So there could be lots of appreciation. This is something you should look into. Not being aware of it could cost you big money at the end of the game when it comes out of the IRA because you blew the tax break. Number 8 on our list also has to do with not being aware of big tax breaks for your beneficiaries. This is something you should tell them about. What I'm talking about here is a tax deduction, very little known tax deduction, even among CPAs, experienced CPAs and tax advisors. This is called the deduction for income in respect of a decedent, IRD. It's the biggest single tax deduction your beneficiary will probably never get because nobody will ever tell them about it. Who gets the deduction? Any beneficiary, that means your kids or grandkids, that inherits an IRA that is subject to outright double taxation, estate and income tax. If they inherit an IRA subject to both federal estate and income tax, that's where you get that 60, 70, 80% tax. That shouldn't happen. If they get hit with that, they qualify for an offsetting income tax deduction, but they would have to know to take it. Sometimes it can run as high as 40% or more. So here's what that means. If your beneficiary, say your child or grandchild, inherits a big IRA that was subject to federal estate and income tax, and let's say one year they pull $100,000 out. Well, if that account was subject to the double tax, they qualify, just to use an average percentage, say about 40%, they qualify for about a $40,000 tax deduction that will be missed. How would you feel if your beneficiaries missed a $40,000 tax deduction? How would you feel if your accountant missed a $40,000 tax deduction? Would that bother you? I think it would. Most accountants actually do know about this, but in the heat of tax season, actually some don't still, in the heat of tax season, who thinks to even ask about it? This is a huge deduction. Somebody would have to pick up on it. And just so your beneficiaries know, this is a personal income tax deduction taken on their own personal tax return. It's taken as a miscellaneous itemized deduction. Most miscellaneous itemized deductions, if you're familiar with a tax return, are subject to a 2% of AGI, adjusted gross income limit. Little known tax rule, not this one. It bypasses that. You know, most people don't even get their miscellaneous itemized deduction because they lose it to something called AMT, alternative minimum tax. Very little known tax rule. The IRD deduction is exempt from AMT. It's one of the rare exceptions from AMT. So it's almost a pure tax deduction. These tax deductions are huge and they're missed all over the place. The IRD deduction by far is the single biggest income tax deduction missed by your beneficiaries because you may not know to tell them about it. They don't know to ask about it. The professionals they use, it just slips through the cracks. And believe me, there's no beneficiary that I know of yet that ever got a letter back from the IRS saying, oh, you forgot this $400,000 tax deduction. That's not going to happen. The biggest one I've seen in our practice is an $863,000 missed IRD deduction. And in this case, this involved a daughter who inherited her dad's $2 million IRA, and she was so upset, she actually did the research herself online and found the IRD deduction because she lost 80%. Nobody should lose 80%. And guess what? She printed it out and showed this IRD tax information to her accountant who already did the tax return. In other words, he got a second crack at the apple. And you know what his response was? He says, oh, that's some esoteric tax thing, doesn't apply to anybody. He missed an $863,000 tax deduction. That's the largest one we've been involved with in our practice, but I've seen bigger numbers. These are big numbers. Beneficiaries will be amazed at how much they overpay their taxes because they don't know about these things. This is on distributions from inherited IRAs. Number 9 on our list, we're getting a little more sophisticated here, incorrect use of trusts as IRA beneficiaries. I talked about trusts a little. I said basically that the IRA beneficiary overrides them, but there are some reasons to name trusts. But I see more often than not people naming trusts because they're told to. Maybe their attorney tells them to. And they name these trusts for no apparent reason at all. And that's a problem because the trust can get pretty complicated and actually accelerate the taxes. Here's what really happens. Let's say you go to an estate planning seminar and you have a good estate planning attorney and he says, you know what, you're a good candidate for a living trust. I've run those seminars myself with attorneys. And many times they'll say, you know what, you should have a trust. And they do the trust. And then they tell the client, you that could be, and say, you know, as long as we have the trust, why not name it as the IRA beneficiary? I mean, we have it anyway. That's not a reason to name it as the beneficiary. You have to have a reason. And the first 2 reasons don't count. You know why? The first reason, when I ask people, why did you name a trust? You know, luckily, some of them come to me ahead of time so we can change it because the beneficiary can always be changed. It's after death it's a problem when this is locked in a lot of cases. And the first thing they say, well, the attorney told me to do it. Well, that's not a good reason. That doesn't tell me why. The second thing, people say, well, it's for the big tax benefit. I'm telling you, there's no big tax benefit. There's no tax benefit that can be gained with a trust that cannot be gained in this area without one. In fact, these trusts can actually accelerate, cause more taxes because of the complicated tax rules. So trusts can work. The reason, if somebody says to you, maybe you should name a trust, I want to know why, and there's only one real reason, and it involves the word control. Some element of the word control, and there are reasons. You have a minor beneficiary as a client, a young child, a disabled beneficiary, incompetent beneficiary, unsophisticated beneficiary, a beneficiary that you might think might be taken advantage of, may be preyed on by predators. They're not that sophisticated, so you want to protect them. Even the stretch IRA, remember we talked all about it? You might be sitting there saying, you know, this stretch IRA is really good, but I have a son, he's 30 years old. So according to what you said, I looked up the life expectancy, he can go out 50 years. But you know what? In reality, do you think that's going to happen? Some clients even say, they'll laugh in my face when I mention it. I'll say, what about the stretch IRA? And they'll laugh in my face. You know why? They'll say, my son? Have you seen him? Look at him. He's a loser. He's not going out 50 years. He's going to have the money spent on the way to the funeral before the body's cold. So don't tell me about the stretch IRA. Well, that might be a reason to use a trust to make sure he stretches it out and gets the tax benefit. You can make sure that happens. So there are reasons to name a trust. But if you do it, you better use an attorney that has specialized knowledge in setting up special IRS-approved trusts for IRAs. There are requirements, and what I see, most trusts don't meet those requirements. Not that they're very hard, it's just that most trust advisors, most attorneys, even if they're estate planning attorneys, see, you might say, well, they're specialists, they should know. Very few of them are familiar with the key provisions that have to be in a trust used to inherit an IRA. So be very careful about the incorrect use. I'm not saying not to name a trust, not to name it for the wrong reasons. But if you do need to name a trust, make sure you're working with an appropriate professional that knows all these little nuances I'm talking about. Mistake 10 I saved for last because I think it's the worst of all of them. You know why? I call it advisor loyalty. Now, the word loyalty sounds like a good word, doesn't it? I mean, I want to be loyal. Who doesn't want to be loyal? Advisor loyalty is a mess. Do you know how many situations I've been in where people lost their life savings to all of these kinds of tax mistakes, and it always came down that they were using the wrong advisor. And I said, well, why did you use that advisor? Oh, he's a nice guy. My father used him. His father used him. I don't want to buck the trend. I want to be loyal to the guy. So I'll leave my money there, then give it to the government, because I'm a nice guy too. You know, your first loyalty is to yourself and your family. Once you accumulate money, you may need to work with a specialist that understands the second half of the game, knows how to create a plan to get the money out, to take advantage of all of these tax benefits. And I find sometimes the worst mistakes are made right under the advisor's nose, and often with his or her direct consent, because they don't know that they don't know. You have to look at this pretty carefully. Loyalty only goes so far. Once you've accumulated money, you want to hold on to it. It may mean moving it from an advisor you had a great relationship with for 20 or 30 years, but now you have to upgrade. Now it's more important to keep this money, and you may have to move it to an advisor with specialized credentials, specialized training in IRA distribution planning, in the exit strategies. I'm telling you, most advisors don't have this specialized knowledge. Even if they were great and they made you a lot of money, it's what you keep at the end of the game. If you have the wrong advisor advising you in the second half of the game when you're taking the money out, all of those gains can go right back to IRS, right back to the government, right back to Uncle Sam. Advisor loyalty is the one that kills it all. Don't just stay with an advisor because he or she is a nice person and they've been in the family, or worst case scenario, he's your brother-in-law. I mean, this is not a reason. Your first loyalty is to you and your family. Take control of your money. Work with great advisors. This piece alone, this program alone, 10 financial disasters you can avoid, will save your family a fortune. I'm sure of it. Good luck to all of you. I hope you get into a lot of this. You may want to look at this over and over again. A lot of technical information here, but it comes down to the same thing again. Using the tax code, mining the tax code for some of these great tax breaks that almost nobody gets to take advantage of. I hope you get to take advantage of, to tie in with our theme of staying rich forever and ever. Remember, Getting these benefits means more money for you now, more money for your retirement, and more for your beneficiaries, and paying less tax along the way, and in some cases, no tax at all. Good luck to all of you, and I hope you stay rich forever and ever for you and your family. Thank you. Hi, I'm Ed Slott, and this program is called 21 Items to Check on Your Retirement Plan. Now that may sound like a lot. Actually, there's plenty more where that came from. But I think if you address these 21 points, you'll have a pretty good handle and you'll be well educated to work with an advisor, the right advisor for you, because this stuff can get complicated. We're talking about taking the money out and not getting wiped out in taxes on the way. So I came up with my 21-point plan that should really bulletproof your retirement account. The main focus of this program is checking beneficiary forms and IRA custodial agreements. So what the heck are IRA custodial agreements? These are the rule books for the financial institutions where you have your IRA money. That could be the bank, the broker, the mutual fund company, the insurance company. These are the companies that have rules on how you can access your money. But even more important, how your beneficiaries can access money. That's why it's important to check these things now, along with beneficiary forms, while you're alive. The beneficiaries, your children and grandchildren, for many of them it's too late to start checking this after you die. Plus, they don't have the leverage you have. For example, let's say as we go through this, you're thinking, you know, my bank doesn't do that. Well, it's your money. You can just take it out and move it. Your beneficiaries may not have that kind of leverage because they can't just take it out and move it most of the time because they might get hit with a taxable distribution. So before we go through the checking of the beneficiary forms, which is critical, and the custodial documents, which I have to tell you, most people don't even know exist. Both of these documents exist. You actually sign these the minute you open an IRA, but most people can't find them. They don't know what happened. Maybe you're at a bank and the bank merged with another bank, and who knows where this paperwork is now. So before we get started, let's go through some basics. First, you have to take an account inventory. You have to know where everything is. People have accounts everywhere. You might have 401k accounts, IRAs, inherited IRAs. So divide them into those groups. Your IRAs, your company plans like 401ks, and IRAs you inherited from someone else. Remember, that is different than your own IRA. Then, another item most people don't think to check is something called basis. That's a tax term, basis in your IRA, or it can be in your plan. This is money that's in your retirement account that you've already paid tax on. In a plan, it can be after-tax contributions. In an IRA, it can be your non-deductible contributions. You want to know that number so that when you pull that money out, you don't pay tax again. Otherwise, you're paying tax twice on the same money. So let's go through our checklist, our 21-point checklist, mainly covering the beneficiary form, which is the critical document for your IRA or company plan, and the custodial document. First, item 1. Now that you know where all your accounts are, you did your account inventory, you have them divided into different types of accounts, now you know which accounts you need to locate beneficiary forms for. So locate a beneficiary form, find out where it is. Now you might say, but I don't know where it is. Well, then you may have to go back to your financial advisor and say, do you have a copy? Or go directly to the institution. And if they don't have a copy, which is likely, sign another one. Get a current beneficiary form. Make sure you go to the bank, broker, fund company, wherever you have your IRA money, and set up a new beneficiary form. This can be done at any time while you're alive. It doesn't work after you're dead. That's too late. Now, once you've found your beneficiary forms or you signed new ones, let people know where it is. Which people? The people that are going to get it, your beneficiaries. Because if they can't find it when they need it, it's the same as if it didn't exist. So make sure your children and grandchildren know where to find those beneficiary forms. Now, this can get a little A little tough because sometimes clients say to me, but I don't want them knowing where it is. I don't want my kids knowing I've disinherited them. I have 3 kids. I only put 2 on. I don't want them knowing that. All right, tell them where to find it in a locked place or something, but they have to be able to access it. Chances are, if you disinherited them, they already know this. All right, so don't worry too much about it. Then, once you've located the IRA beneficiary forms for all your IRA accounts, and you need beneficiary forms for your plans, and even inherited accounts. You might say, but I already inherited. My dad died, I'm the IRA beneficiary. Why do I need a beneficiary form? We're going to get to that later. But you could die too. It happens. A beneficiary needs a beneficiary, so we know where the money is going to go. Number 2 in our list of 21 items, locate the IRA custodial agreements for each of your IRAs. Now, this may be a little tougher. You may need help of a financial advisor, or you may want to go back to the bank, broker, fund company, and they may not even know what you're talking about. So you may have to work your way up the ladder there. Say, well, let me speak to somebody who handles this, some specialist in your IRA department. You want to see the custodial document. And this way, now, after items 1 or 2, you have the beneficiary forms and you have the custodial documents. Now we begin checking them. Number 3, we're on the beneficiary forms now. Is the beneficiary form current? Does it include changes in your life? A birth, a death, a marriage, a divorce, anything that might change your choice of beneficiary. Maybe a marriage of your children or grandchildren. This is the biggest thing that parents tell me they're worried about when we do planning. They said, well, I don't have any problems with my kids, but one of my kids just got married. My kids are okay. It's the ones they marry. So that may be a reason. You may want to set up a trust. Some people might need trust. You might have beneficiaries with special needs, adopted children. You have to know who all the players are, who you want to get your money, and make sure these beneficiary forms are up to date. Number 4 on our list for the beneficiary forms, have you named both primary and contingent? Very few people can even find a beneficiary form, but that won't happen to you because of this program, hopefully. But even the few people that have beneficiary forms, they might name a beneficiary, but they neglect to name a contingent beneficiary. The contingent beneficiary is very important because if your first beneficiary dies before you, we have to know where it's going to go. You want to be able to have say where it's going to go. It's going to go to the next named beneficiary. That's why you want a contingent, a secondary beneficiary. Just a backup plan, but it's extremely important. Number 5. Have you considered the effect of disclaimers in your planning? Now, I put this as number 5 because I just talked about the importance of contingent beneficiaries. Let me explain what a disclaimer is. It's a legal right to refuse an inheritance. Well, who on earth would do that? Who on earth would refuse an inheritance? It's actually a great plan. Here's a scenario. Let's say you want to leave your spouse as your IRA beneficiary, but you don't know what financial straits he or she might be in when the time comes. You want to make sure, maybe if your kids are next in line, to name your kids as contingent. If it turns out that maybe you had, hopefully, life insurance to protect your spouse, when you die, she might say, I've got all this tax-free life insurance. I don't really need the IRA. I'd rather have it go to my kids. Well, she can't just give it to the kids. That would be a gift. She can't redirect who gets it. All she can do is say, I don't want it. I'm disclaiming. I'm saying I'm refusing this inheritance. And she has 9 months, anybody has 9 months from the date of death to refuse an inheritance, to disclaim. If she does that in our example here, then she's treated as if she died before the IRA owner, and the contingent, the children or child, moves up in her place, and they become the beneficiary, and they get to use their own life expectancy to stretch it out, to parlay that wealth over a much longer life expectancy than the spouse, than the mother. So this is a very effective strategy where you can actually change the plans after death. So the disclaimer is key to consider, but it will only work if you have a contingent beneficiary. You have somebody next in line who it would pass to. Item 6, and on item 5, that's something you may want to go over. It's a little technical with your estate planning attorney or your financial advisor, but it's important to consider disclaimers in any kind of plan. It's just a plan B that can go into effect after death. You don't know what the financial situation is when you're setting this up, so it's a good plan B. Item 6, does your financial advisor have copies of all your beneficiary forms? I would check that. I would also check that they know where to find them, that your children or beneficiaries know, go to that financial advisor. They have all the latest beneficiary forms on file. That's a good safety net, because what if you do go to the bank, a broker, and their forms are in current, or they can't even find them? Actually, it's best to get directly to the institution, the bank, broker, or mutual fund, because they will have the final word, but they may not be up to date. They can't find them. This may save you. At least your advisor may be able to come up with, well, the bank didn't find the beneficiary form, but I have one and it's signed. And that may be enough to save the stretch IRA for your children. Number 7, this is critical. We talked about finding the beneficiary form, but let's say you find it. Is the beneficiary form you have the one that matches the one that's on file at the bank? Yours may be an old one. Maybe a bank merged or changed names, or they changed some of their provisions, and there's a different beneficiary on the one at the financial institution than the one that you have. Well, that one will probably trump yours. So you want to make sure you have some kind of acknowledged copy. Acknowledged, what does that mean? Well, get it signed by somebody at the bank, the broker, the fund company. Anyone at the bank will do, just so you have something signed that this is the acknowledged copy that they have on file. Anybody will do. Have the janitor sign it. He's probably a vice president anyway. Anybody at the bank will do. Item 8, does your financial advisor have copies of your custodial documents? And is he or she familiar with all the distribution options permitted in the custodial document? This is where you need professional help. But they should have copies of the custodial document, not only the beneficiary form, but also the custodial document. That's an important document that lists all the options that will be available to you and your beneficiaries when you pull the money out. Item 9 in our list of 21, does your choice of beneficiary consider your overall estate plan and other assets? Remember, the IRA may be a big asset for you, but you have to consider other assets. Do you want to leave it all to the spouse? If the spouse is getting everything else, you might want to say, you know what, maybe we'll leave the IRA to the children, because this way we can pass it through the exemption, the estate exemption at the first estate. You have to consider other assets. There may be beneficiaries that you want to get other assets and maybe not the IRA. So you have to integrate it with your overall estate plan. The only way to do that is make a list of all the assets you have, see who you want to get what, and then you work on that with your advisor to see what the tax ramifications are, estate and income tax, of selecting a certain beneficiary. Now, of course, you don't want taxes to wag the dog on this, so to speak, but because not everything's about taxes. You should be able to leave your money to whichever beneficiary you want, but you should know what the tax effect is. And maybe there's a way to lessen that effect and still have the beneficiary you want. Item 10, does your beneficiary form name a person? That's key. Otherwise, you won't get the stretch IRA. What do I mean by a person? As opposed to the estate. A charity, a trust, those are not people. Those entities will generally not be able to stretch the money. A trust might if it's a separate qualifying trust, but most trusts probably not. All estates, if you name the estate or if you name a charity, they're not people. They don't have a life expectancy. So if you want somebody to get the great parlay of wealth, what I call the stretch IRA, you're going to have to make sure a person, a human being, is named on the beneficiary form. Only people have life expectancies. Number 11, will you need to name a trust as your IRA or plan beneficiary? That may be the case for some people that have control issues. Maybe you have some children that you feel might squander the money or don't know how to handle big sums of money. If you think you're heading for a trust, there are special IRS rules that are required to be followed for a trust that is named as an IRA beneficiary. It is essential that you work with an attorney and an advisor that understands the complicated trust rules. Not only do you have the IRA rules, but the complicated trust rules. A great estate planning attorney with expertise in IRA distribution planning would know how to do this. But first you want to see, is a trust right for me? And generally it involves control issues. If there are no control issues and you don't mind your beneficiaries getting the money straight out, you probably don't need a trust. Item 12, do you want to leave any of your IRA to a charity? A lot of people do. Well, that's a pretty good move actually. If you're charitably inclined anyway, the IRA is the best asset to give to a charity. Why? Because it's filled with tax. The only loser there is the government. The charity doesn't pay tax. You're better off giving your family other assets, not the ones that are filled with tax like IRAs. But if you are naming a charity, be very careful. Let's say you're naming children and a charity. You're not giving the whole thing to the charity. I would probably advise to set up two separate IRAs. In other words, split the IRA. Let's say you want your 3 kids to get 90% of it, but 10% you want going to the charity. I would probably split it into 2 IRAs, one for your 3 children, and you name them 1/3 each if that's what you want, and one for the charity. The reason you don't want to mix beneficiaries like a charity and children, charity and people, is because a charity doesn't have a life expectancy. And the rule is, and this is a tax rule, that when you have different types of beneficiaries, the payout on the stretch IRA, in other words, that life expectancy, you have to use the age of the oldest beneficiary or the one with the shortest life expectancy. So what does that mean? Well, it means if you have your children on with a charity that has no life expectancy, the children have no life expectancy. So they blow the stretch IRA even though they're getting 90% and the charity's only getting 10%. So the better option, split it out. Now this can be fixed at death if people know, if your beneficiaries know to split it out timely, generally by the end of the year following the year of death. But I like to make it risk-free and make sure this is a done deal. Probably better off leaving a charity. If you want to leave them a piece, split out 10% if that's what you want to leave to your charity, and put it in a separate IRA and name the charity as the beneficiary on that IRA. On the other 90%, you can name the 3 kids. Now, the same rule applies for the 3 children, and that's item 13 on our list. Are there multiple beneficiaries? That means more than one beneficiary. The same rule applies. You use the age of the oldest. If there's 3 kids, it's probably, and they're close in age, it's probably not a big deal. But if you have Aunt Edna, who's 101 years old, and your 1-year-old grandchild, the grandchild's going to have no life expectancy. They'll have to use the life expectancy of the 100-year-old, which is a couple of years. So you want to split that if you can. Again, that can be split after death. But the important part, when you have multiple beneficiaries, make sure each beneficiary's share is clearly stated by using a fraction, 1/3 each, a percentage, 30%, 40%, 30%, or the word equally, if that's what you desire. You have to know who gets what. We had a situation a few years ago where there were 6 sisters. The plan was that the 6 sisters should get Mom's IRA 1/6 each. But all she did was name the 6 sisters. She didn't use a fraction, a percentage. She didn't even put the word equally. So when the sisters went to the bank after Mom died, the bank said, well, we're only going to pay the first sister because she's the first one named. We don't know what your mother meant, and she's not here. So then they came to see me. What can we do? Because the bank is saying, sister number 2 will only get after sister number 1 dies, and sister number 3 will only get after sister number 1 and 2 die. How, you know, want to honor Mom's wishes. We know she meant for us to get it equally, but the bank won't do that. And the bank won't do that because they don't want to assume what Mom meant. So what happened is, because they wanted to make it equal, number 1, who could have been a real creep and taken the bank would have paid number 1. She could have taken it all and been a real creep with the bank's blessing. But she wanted to honor her mom's wishes, so what she did, she took out all the money, paid the tax. That's why they came to see me. They wanted me to divvy it up so that everyone shared the tax. So when it all came out, they ended up netting about the same money after tax. But the first one paid all the tax, and then the others just got less to make it all even. This could have all been avoided if they just put the word equally, or 1/6 each. So that's why it's so important to use a fraction, a percentage, or the word equally if that applies. If there's multiple beneficiaries, this is item 14 now, then who are the primary beneficiaries? Maybe you have 3 primary beneficiaries. Do their percentages add up to 100%? You know how many times I've seen, I have 3 children, I want to give them 50% each. That doesn't add up. I've seen this many times. Or I give them 20% each, and that only adds up to 60. What about the other 40? I know it sounds simple, but that's why I'm telling you to check this. I've seen problems in this area. If you have multiple beneficiaries, whether it's primary or contingent, make sure their shares add up to 100%. Sounds easy, but it's a big problem if it doesn't, because then somebody has to try and figure out what did mom or what did dad mean, and who gets the rest of the money. When you have multiple beneficiaries, you also may want to create separate accounts. Let's say you have 3 beneficiaries. You may want to create 3 different accounts and name beneficiary number 1 of account number 1, child number 2 is account number 2, child number 3 account number 3. Or they can split their shares after death. If they split them timely, by the end of the year following the year of death, they can still use their own life expectancy. They won't be locked into the age of the oldest. But then, if you don't create separate accounts now while you're alive, you're relying on them to know to do this after your death. So probably the safe way is make separate accounts now, but that means handling, if you have 3 kids, 3 IRAs instead of 1. So if you don't want to do that, then put it all as one, name the 3 kids with their fraction or percentage, and make sure they know to split it up timely so they can each use their own life expectancy for their own stretch IRA when they inherit. Item 15, does the beneficiary form allow something called per stirpes? It's an option. And here's what it means. It means that if your beneficiary dies before you, their share goes to their kids and not the other 2 kids. Let's say you have 3 kids, 3 children as beneficiaries, 1/3 each. But child 1 dies before you. Then you die. Where's child 1's share going to go? You probably want it to go to child 1's children, your grandchildren. That's what per stirpes will accomplish. By putting per stirpes, it means when child 1 dies, child 1's children move up in the shoes of child 1 so they don't get disinherited. If you don't have that, guess what? Child 1's share will probably go 50-50 to 2 and 3, and the grandchildren from child 1 will be disinherited. That's horrible. Just because their dad or mom died, they become disinherited. It's a double whammy. It's not good. So you want to make sure that your financial institution or your custodial document will allow a per stirpes beneficiary designation. Sometimes they just write it in. Now we're talking about the custodial agreement. Will your IRA custodial agreement with the financial institution allow for the stretch IRA option? I'm talking about it in all our programs. Stretch IRA, the great parlay of wealth. The government allows this. But here's an amazing thing. This is one of those areas the tax law is more liberal than some plans, than some banks and brokers. Now, I've got to believe that most institutions are up on this now, but I would check. You'd hate to find out too late after you die when your kids come to collect that you're with one of the few banks in the country, or brokers, for example, that doesn't allow the stretch IRA, and they pay your kids out, and they pay more tax quicker. So check that they allow the stretch option. I'd be shocked to find institutions that don't do it anymore, but it happens. It pays to check. Next item on our list is checking again on the custodial document, item 17, will your custodial agreement allow, and watch this, your beneficiaries to name beneficiaries? Remember I talked about this? Your beneficiary should name a beneficiary as soon as they inherit. What's a beneficiary's beneficiary? It's actually called a successor beneficiary. So let's say your dad dies and you inherit. Now you're the beneficiary. The first thing you do, even if you're allowed a 40-year stretch, a 40-year payout, the first thing you should do is name your own beneficiary so that if you die before the full payout, you know where it's going to go. It's going to go to the person you pick, and it won't go through your estate, and they'll be able to continue. They can't tack on their own life expectancy, but they can continue the remaining years in your payout term. So if you had a 40-year payout based on your life expectancy and you died 10 years in, that beneficiary would be able to continue the other 30 years to keep it growing tax deferred. But the institution does not have to allow a beneficiary to name a beneficiary. That's why I'm saying to check these things now while you have the leverage. Because if you go to that, good, take out your money and bring it to a new institution. Your children won't have that option because children are non-spouse beneficiaries and they can't do rollovers most of the time. They can only do trustee-to-trustee transfers, and we don't know if institutions will allow that. And that brings us to our next point, item 18. Check to make sure that your non-spouse beneficiaries, the money they inherit, their inherited IRA from you, is not held hostage by the institution. What do I mean? Well, I just said, will the institution allow your beneficiaries to move it from there? Let's say they don't like those investments, to some other place. They don't have to allow it. If they don't allow a trustee-to-trustee transfer, they can't hold the money literally hostage. I mean, your beneficiaries could say, the heck with this, I'm taking the money out. And they have to give them the money. But then it's all taxable. The only way to avoid the tax, to move inherited funds, is to move it by a trustee-to-trustee transfer. What is a trustee-to-trustee transfer? It's where the money goes from one institution to another, from one IRA to another, without anybody touching the money in between. That's the only way inherited IRA funds can be moved without triggering a tax. Now, it's up to the custodial agreement whether they will allow the beneficiaries to move money out via a trustee-to-trustee transfer. If they don't allow it, your kids are stuck there. Either they're stuck there or they can pull their money out and pay all the tax. Either option is pretty bad. Check this out ahead of time to see if your custodial agreement will allow your beneficiaries to move money after you die via trustee-to-trustee transfer. Same thing with this. If you find they don't allow it, you have the leverage now to move it to a new institution that will allow it. And a lot of institutions will allow it. Item 19. Will your custodial agreement accept a trust as your IRA beneficiary and pay out your beneficiaries according to the terms of your trust? They don't have to. So imagine this. You spent, I don't know, $10,000, even more, with some fancy attorney and accountant and setting up all these sophisticated trusts, and you name them as beneficiary of your IRA. I've seen this happen. Then somebody dies, and the institution says, oh, we're not going to accept that trust. Should have asked us first. I'm telling you to find that out now. After you do all this legal work, make sure the IRA is with an institution that will accept the terms of the trust and pay out according to your wishes in the trust. Not all institutions have to do it. This is why you want to check this now. Point 20. Will your custodial agreement accept your power of attorney? Let's just talk for a minute what a power of attorney is. It's a document where if you become ill or disabled or incompetent or can't act for yourself, somebody that you give power to, it's usually a spouse or a family member, better be somebody you trust, can do these transactions for you. And a lot of times, you have a power of attorney for your IRA. Here's a situation. Let's say you're over 70 and a half. You have to take required distributions. Let's say you're 80, but you're very ill, and you can't even take the distributions, but you have to. You know, it's a 50% penalty if you don't take a distribution, a 50% penalty on the amount you should have taken but didn't. Well, it would be great to have some family member, let's say, have a power of attorney where they can take the distribution for you if you're not up for it. But you have to make sure that the institution will accept your power of attorney. Check that with your financial institution, the bank, the broker, a mutual fund company. Check it now while you're well. Say, look, if my husband or wife or children come in here, if I'm not capable of handling my own affairs, or maybe I'm just not even around, maybe I'm in Europe somewhere, will you acknowledge this power of attorney and let them take money out? Some of these powers, they can be extensive. This is something you may want to go over with your estate attorney, who may help you. And you shouldn't probably be doing these yourself. I know you can do these things online, but I wouldn't recommend it. You should go to a qualified attorney who can prepare a power of attorney for you. But still, just because you have it doesn't mean the IRA institution will accept it. This is something you have to check in the custodial agreement. And the last item, which is a very important item, all of these are, I think you're starting to realize, item 21. Check the default provisions in your IRA custodial agreements. What does this mean? Hopefully it'll never happen to you. It means, let's say, the worst thing happens You die and they can't find a beneficiary form, or you never filled one out. I find this hard to believe because if you're listening to this program, I must have said it 100 times. But let's say it does happen. And actually, it does happen more than you would believe. Your beneficiaries can't find the form. Maybe there was no form. So the custodial agreement spells out a default option. What does that mean? Under the section that says, what if there's no beneficiary, the default option will say, if there's no beneficiary named or you can't find the form after death, we're going to say who the beneficiary is. And normally they say, we're just going to say it goes to your estate, which is the worst choice out there. It means there's no chance of your beneficiaries getting the stretch IRA. You may want to look for a custodial document that has better default language. For example, they might say, well, if there's no beneficiary name, first we're going to leave it to your spouse. If no spouse, then your kids. So you have two lines of defense. And then if no kids, then it may go to your estate. Either way, it's not a great situation, but it could save the stretch IRA for your kids, even if they can't find the form. If the default language, and there's no spouse, let's say, says if no spouse, then it goes to kids, then they're treated as if they were named on the beneficiary form. Very few people know there's even a default beneficiary on every IRA, on every custodial agreement. These are things you need to check. Well, we went through a lot in a short amount of time, but I think it gives you an idea how important it is to check these items. And these are probably the most critical items. I think if you check most of these items, and I think you should check all of these items really, you will be in good shape to get the biggest tax benefits for you during your lifetime and for your beneficiaries after you're gone. So they have the best options. This is one of those areas where the tax options are available to everyone, but not every institution is required to allow all of these options. It really is a crazy system. You would think the tax law would be tougher than your own bank or broker. Not the case. The tax law has, in this area, has a lot more flexible options and gives you greater options for your beneficiaries and you than sometimes your own financial institution. That's why you have to check these things. So remember, go back, first take an inventory so you know where everything is, then start hitting this list. Go over it with your financial advisor. I can guarantee you if you hit all these points, you will stay rich forever and ever, and that's what this show is all about. More money for you now, more money for your retirement, and more for your loved ones who can keep it growing over the rest of their lives. I hope you take advantage of it. This one may take a little work, but I'm telling you it will pay off maybe for generations. Thank you very much. Thank you.